Okay, a very warm welcome everyone, and thank you for taking the time to join us today. This morning, we are concentrating on the impact that the current economic environment is having on UK SMEs. We are focusing on cash, the funding landscape, supply chain disruption, and amidst all of this, the rising costs that businesses are facing. My name is Lucy, and I'm a director here within the accounts team at Pierce, and I'm joined today by Alex Brandreth, Chief Investment Officer at Luna Investments, Pete Norris, Relationship Manager at Alica Bank, and Stephen Bell, Corporate Finance Director at Pierce. Before we get started, just a couple of housekeeping points. We will be recording the webinar and we will circulate it afterwards to all attendees. If anybody has any questions, please use the Q&A box. We will, where possible, try to pick these up as discussions happen, but failing that, we do have time allocated at the end to go through them. Just a point, if you do leave a comment anonymously and we don't get around to answering them, then we won't be able to follow these up afterwards with you. And as mentioned, we do have time at the end for any further questions. Let's dive in. Alex, how is today's economic environment affecting businesses compared with 12 months ago? What impact are we seeing from the conflict in the Middle East?
Hi Lucy, and morning everyone. Thank you for having me to speak today. Thanks to Pierce. I think if you go back 12 months ago, even if not have to go back 12 months ago, if you go back to the beginning of the year, then there was an expectation that through the course of this year, interest rates will be cut. And there was in December, it was expected that interest rates would be cut twice. So we're at 3.75% today, and we'd be going to 3.25%. As soon as the war started, you saw commodity prices spike, most notably crude oil, natural gas, and fertilizer stock, because so much of those commodities travel through the Straits of Hormuz. And the closure and the season of what's going on is effectively making you aren't getting those commodities out, and it's really starting to bite now. So the expectation went from 2 interest rate cuts from the Bank of England to, at one point, you're going to see 2 or 3 interest rate rises by December this year. Now, the market expectations are tempered a little bit, and it's currently expected that you'll see 1 interest rate rise. So we'll be going back to potentially 4% interest rates in December this year. So what has that meant? Well, from businesses, it means that the cost of financing is increased. You're expecting interest rates to be coming down, and now they're going up. If you've got money in the bank, it's probably a slight positive maybe. You're going to get a slightly better rate of return on your cash. But for businesses, I mean, what I've noticed and the people that we speak to here at Luna is that they're feeling cost pressures already. It depends on the business, because not every business is the same. But you've already started to see the oil price started to increase, which is impacting the price at the pump straight away. You've seen individual industries like the airline industry, which have been impacted by the fact that they're unable to get as much fuel as they need. So there's certain sectors and areas that have been impacted already. I might pause there because there's probably a bit more we can go into a bit more detail later on.
Yeah, perfect. And Pete, what are the changes that Alex has mentioned that are meant for the funding world? Lending appetite, lending criteria, has that changed at all in the last 12 months in response?
Yes and no. I mean, what I'd like to stress is the funding is absolutely still available.
Yeah.
Yes, as a funder, we will stress test energy costs against historic, just for prudence sake, but funding is available. At Alica, we haven't adjusted our rates as of yet. Don't get me wrong, there are pressures, and the longer this continues, then the more likelihood that the rates will rise and the swap rates keep going out. There is going to become more pressure on funding and funding rates, but the funding is still available. What I would stress is that businesses do engage with the external stakeholders, whether it's Pierce or whether it's the banks. You know, and it's not just the big 4 or 5 banks. There are a lot of funders out there. Whether it's Alica, whether it's them and other funders out there, always have a good relationship with the banks and engage them early, because there are opportunities and there are options available to businesses.
Hey, if I can ask a question, just as a relatively new funder in the market,
yeah,
an innovative funder, what type of opportunities are you seeing being presented to you? Because obviously, from a CF perspective, we're seeing some real challenge with high street banks. You know, unless it's a gold-plated lend, it's very difficult to get it through their process. So, you know, what type of things are you seeing with this background to, you know, the risks and stresses that are there in business?
I've got a bit of a unique angle at this because I had 20 odd years at the big banks.
Yeah.
And now I've gone to a fintech, digital, agile business. So there are a lot of businesses, and I'm not going to bash the big banks because I had 20 good years there. But there is a lack of relationship managers. So a lot of businesses just don't have anybody to speak to. And you're right, some of the big banks will cherry pick. I've been there before, and if it's gold plated, they'll do it. But if it's got a bit more risk to it, they may not do. Now, Alloca isn't a third tier risky lender. You know, we'll lend at the same rates as the big banks do, but we will do deals where the big banks won't. You know, and sometimes that's the smaller deals. You know, we will do, in your world, the CF deals sub 2 million quid. You know, the 400 or 500 quid MBOs, MBIs, acquisition finance that the big banks just won't roll out their corporate finance team for. A lot of the time, it's just the agility and speed that which we can work. You know, we can put a deal on the table within 48, 72 hours rather than waiting weeks and months. And sometimes it's time critical.
Yeah.
And sometimes it's just that relationship. Because we are boots on the ground and we're all local, you know, I'm a Bolton boy and cover Lancashire. We are local relationship managers, and we can get to businesses and see them face to face, and we're not turnover driven. You know, we'll go and look at a business that does a couple of $100,000, or we'll go and look at a business that does 40 million. When we're not specific.
Yeah, cheers.
And I suppose you mentioned there having those relationships with your stakeholders and with your advisors. How should businesses be proactively thinking about their cash flow and funding? Do you know if they were to come to you with a need, what kind of proactivity would you be expecting from them?
Accountant like your good selves, who's got up-to-date annual accounts, management accounts, cash flow forecasts. The amount of times we get a lending request and we haven't got up-to-date financial reporting, and it just makes our life harder. And I would say just engage the banks, engage your funder, always have an option and get to know us. It might not be that we do your day-to-day banking, it might just be that you keep us as a contact. But then the more we get to know businesses ahead of when issues arise, the easier it is for us to become a funder and support.
Yeah. I think we see it all too often within our client bank, where there is that lack of relationship with the banks, and they go and they get a no, and they don't understand why that's a no, and often it's a very slow no as well. And at that point, then it is critical to them that the funding is needed, and it can be a struggle for businesses where that relationship isn't held. So I think that stakeholder relationship is key in times of uncertainty. Okay. So, Alex, we're seeing cost pressures from multiple angles, as you touched on slightly earlier. What are our headline risks causing the most disruption right now versus our hidden risks that potentially are being underestimated by clients?
I think it really depends on how long this goes on for, and that's the thing that no one knows. The longer this goes on, the bigger the inflationary impact, the bigger the delay there is in terms of getting fuel out there, and therefore the bigger the inflationary impact that comes through. And subsequently, that means that it's going to be weighing on economic growth. So economic growth is going to be weaker. So that's the dilemma for the Bank of England in terms of trying to manage that. So where are the risks? It's risks specific to any industry that's exposed to commodities. And something we were talking about last week, Lucy, which maybe people on the call might not want to hear, but again, we don't have to go far back to remember the last time something like this happened. It's a bit different this time as opposed to when Russia invaded the Ukraine. When Russia invaded the Ukraine, inflation in the UK was running at 5%. When the Middle East conflict started, it was at 2%. Interest rates back then were basically zero, and they're starting today, as I said, at 3.75. So the starting point is slightly different. But the longer this goes on, then the bigger the inflationary impact, then it then turns into the second order inflation. So if we're all seeing our energy bills going up again by, I don't know, 5 to 10%, or let's just say that's where inflation ends up, then the first thing that we're all going to do in 6 months' time, 12 months' time, is then to go to knock on our boss's door and say, please, can I have a pay rise? Because that's what, the cost of living is impacting us. Again, we're going to go through it again, like we did only a few years ago. And so again, so businesses, one of the biggest costs that they have is their employment, and trying to keep their people happy and trying to keep them motivated, and salary is a big part of that. So as I say, it's all linked to Donald Trump, which is incredibly difficult to call. But the longer this goes on, the greater the risk that those cost pressures and the second wave impact start to come through as well.
Yeah, and I think labour costs often they do prove to be the most disruptive in practice, because they are a persistent cost. They're not a temporary cost where we see our energy fluctuating, and I think once they feed directly into clients' ongoing cost base, and it's really hard for businesses to reverse them once they are embedded in there. I think we see in sectors kind of boots on the ground where recruitment and retention remain difficult, and businesses then have to pay more to attract staff and keep them, and there's a higher rate of overtime. So I think you've got all the noise around fuel and commodity pricing, but then I don't know, labour is always one that kind of creeps in and that is there and is a real point when we're speaking to clients that, yeah, they're up again, the costs are up again in terms of labour. And I suppose, Pete, from what you're seeing across customers and businesses, what cost pressures do you see causing kind of immediate strain in practice?
A bit like Alex said, the labour costs. I mean, the biggest issue I see with businesses is when the costs go up, they can't just pass on the price increases to their clients. It takes 6, 9, 12 months, even longer for some businesses, depending on the contracts that they're in. From a lending perspective, things are pretty flat at the moment. The cost of the borrowing hasn't moved, but there is that pressure that it could do in the short to near term. On the flip side of that, like Alex said rightly, there is an opportunity there for people who are lucky enough to sit on deposits. Banks do pay money on deposits. So, again, there is an opportunity there to offset some of the cost rises by making sure your cash is working harder for you.
I think there's also additional cost pressure on employment. I mean, because how long ago was it that the government introduced the increased national insurance? Which was a direct cost that for every business out there. So, I think there's obviously the economic pressures that are happening. The changes to oil, the changes to everything else, but then there's the kind of maybe shooting ourselves in the foot with regards to national insurance increases. There's also, is it the strengthening of employment rights that all of a sudden puts those extra pressures on business, where they're thinking, right, do we invest or do we just keep our cash pile? Do we try and survive, or do we invest for growth? I think it's a real challenge. Do you see any of that, Alex, with the kind of political pressure or the political decisions that are made having an impact in what you see? Absolutely.
It was only last week with all the noise around Starmer and is he going to be Prime Minister or is he not going to be Prime Minister, that the government bond costs increased significantly. So we got to the highest in 30 years in terms of how much we have to pay on our debt as a country. And that's all because of the uncertainty that's coming through. I mean, what the government have done over the last 2 years, and this is a personal opinion and I have no political support, but I think has been very bad for business. It's not been pro-growth despite what's been coming through, and that's the feedback that we've seen, and that's why the UK economy's kind of been bumbling along. So, and then the political uncertainty that was started last week, again, it impacts the way that we live our lives. I mean, the sad situation is that as a country now, we have 100% of debt to GDP. And other countries where we're relying on financing look at us and say, well, how stable are you and how reliably are you going to be able to pay that debt back? And when you have this political uncertainty about, well, are these financial rules going to be there in the future? That's why the cost of borrowing increased. So for us, from an investment perspective, that's what we've got to think about. Ironically, I would actually say it's probably a good time to buy government bonds at the moment. If you're looking for something not very exciting in your portfolio, it's just going to go away and just do as it wants. Because when the best time to buy anything is when then you get lots of uncertainty. And for us, the last few months have been, again, a really good, interesting time to be invested. Last year, when you had all the tariffs, no one wanted to invest, stock market fell. But the FTSE all share ended the year up 26% last year. It's an astonishing year. And then in March, you saw exactly the same thing again. Stock markets collapsed. Then you get this potential deal in April of a ceasefire, and they're back to all-time highs again. So for us, this is where opportunities arise on a day-to-day basis, and there's opportunities to take advantage and make clients decent returns during periods like this.
Yeah. And I think when they are uncertain times, I think many businesses instinctively move into cost-cutting mode, but the real challenge for them is knowing where to reduce that spend sensibly, and where pulling back too far can actually reduce or weaken their resilience. I think, Alex, Pete, for business owners deciding where to cut and where to keep investing, how can they tell the difference between that unnecessary spend and that strategic spend? What kind of would make that plan credible from an investment and funding perspective?
I mean, what I would say, it must be an incredibly difficult position for the business owners to be in right now. Well, say right now, say for the last few years, because we've been through it for many years on the uncertainty front, and businesses don't like it and funders don't like it. CapEx is one that we see from a spending perspective that's always kicked down the road, whether it's the maintenance or investment in P&M, plant and machinery. And, it can be a cost that you can cut, but in the long term, it can have effects because it can cost you more if you're not maintaining the fleet. Marketing and staff are probably the other two big ones we see. Marketing is always an easy one to cut. It's probably one of the first levers businesses pull, but in the short term that can work, but long term, from a lead generation, sales, top line perspective, it can hurt. And staff, I think we've alluded to. I mean, cutting staff, then you've got the morale and the motivation that goes along with it when you're putting more pressure on what is already probably a stressed workforce.
But then I think also on the end of that bit, you've also got the recruitment afterwards once we come out of it.
Yep.
I think, it's really difficult to recruit people at the minute. I don't know what the employment rate is, but I think skilled staff are in demand. And I think from, what we're seeing in our sector is, some of the staff who might be on here may not agree with it, but, the pricing of staff, you're having to pay more. I think someone said before, you're having to pay more to recruit. And, it might be a job seekers market to a certain extent across lots of sectors. Highly skilled workers are in demand. And therefore, that puts that extra pressure on. If you've taken the costs out, have you cut costs and then you've lost your flexibility and capacity? Because as soon as it comes back, there's even more cost pressure then, isn't there?
Please. And, I see it in a lot of businesses that I look after.
Yeah.
And you're right, it's the skilled workforce that's the difficult one. Finding numbers and bums on seats is generally okay, but finding the right skilled person is difficult. And a lot of businesses are struggling in a lot of industries for that. And banking is no different. We're struggling to find time-served, experienced people. And it's not like they can come in and hit the ground running either. It's, your 12 to 18-month lead time on top of all the costs of recruiting that extra person.
Yeah, I think we see it a lot within engineering and manufacturing, our client base there, that it is that skilled workforce. And I think often our SMEs lose out to the kind of the BAEs, the aerospace, engineering, the Bentleys, because they are, I don't know, they're seen as kind of more attractive roles than commercial properties in the middle of Accrington and Haslingden, but essentially they end up paying because they are competing with larger people. Steve, from a corporate finance perspective, do you see companies cut costs that then weaken the story that they potentially take to funders or investors?
I suppose from a CF perspective, we're always generally looking at the businesses that are successful. So we maybe don't see some of the dark side of the ones that are struggling. But I think, it's, people have seen it when he receives the documents that people like myself produce. You're trying to tell a story. The story that you're trying to get a funder like Pete believing in is the business. You have, maybe an initial conversation. You then put a document together that might be 15, 20 pages. So you don't have a great deal of time to get that story across. But ultimately, Pete, as Peter said, he's been around the circuit for 20 plus years in the main banks. He'll have seen everything. And you can look at the business and say, right, well, why have you cut those costs? What costs have you cut? I know I'm working with a client at the minute that's gone through some challenges. Turnover's fallen maybe 20%, and we're starting to look at which costs can we cut, which is maybe discretionary. So I think it's which is discretionary, which are the hard-coded fixed costs. With regards to staff, do we reduce the staff numbers but then lose capacity later? Because our growth is, we are looking to grow over the next 3 to 4 years. So I think it's maybe difficult to see that, I think we see the well-managed businesses because they're the ones that are looking for funding. We don't really see within the CF team the distressed businesses where they've maybe got those challenges where they've taken those costs out. But I think it's a factor of all businesses. It's just, we want to be able to present a story to Pete that he can take to his credit committee that says this is a credible business that you want to support.
Absolutely. And I suppose, especially in your world, Steve, it's like you get one chance to sell a business, don't you?
Yeah.
So it's making it as most attractive as possible.
But saying that, you do think you get one chance to sell a business, but I'm currently I'm currently in the process of selling a business that I nearly sold 4 years ago. And what happened there was, I think we were 3 weeks away from completion. There was a slight delay with regards to a tax issue. And in that 3 weeks, turnover dropped 30% because I think it was just after the Ukraine conflict had started. Commodity prices went through the roof, margins fell, customers just backtracked on, our clients' clients backtracked on some of the, so it just killed the deal. And so those are the challenges. And I think it maybe touches on something we'll talk on later, is about planning, strategizing for not for conflict, but for change. Change, I think, is a fact of life now rather than a one-off. It's not something that happens every 3 or 4 years. It's something that seems to happen every year. You go back from whenever it was 2015, 2015 Brexit, a couple of years later COVID, a couple of years later changing, how many different prime ministers did we have? The 47 days of Liz Truss and everything, so it's just, I think, it's uncertainty for business that they just have to get used to. I don't think there's any normal now, really.
Sorry to interrupt. I was just going to say that's a really important point that we've been saying. And I was speaking to someone last week, fund manager, and he just said, are people just getting too complacent or used to all these events that we seem to lurch you from one day to another? And he said, no, I just think people are numb to it now. But we've had so many events, like you mentioned, over the last few years that businesses just plow on and just crack on. They did the GDP growth figures that came out for the first quarter were a lot stronger than anyone had anticipated, because businesses, despite the backdrop that we're going through, are just getting on with it and just carrying forward. I was going to say there is a question in the Q&A box, Lucy, and if you want to get to that.
Yeah, I think let's move to that. So with staff costs rising, is anyone seeing businesses actively embracing AI to reduce headcount? I don't know if anybody on the call wants to jot their thoughts in. I was actually out at Accountex last week in London, and there was a huge drive on this, on using AI agents in real life, and kind of we're going to go from that human-led to AI-driven approach with humans overseeing multiple agents, which was quite a frightening concept, actually. I don't think that we're seeing, I mean, I don't think at this point AI is reducing headcount. I think we're in that exploratory period with AI where, yes, it is making our life, it can make our life easier, but I think we're very much in that preliminary period with it where it's not yet kind of 100% reliable. You can see it moving there. You can see how kind of, I don't know, engines are learning from us, especially within our kind of bookkeeping and finance function. Things being scanned in, automatically picking it up, it does make it easier, but there is that sense check that is needed. But I think definitely from a training on the ground to our junior team, there's going to be a move from actual processing to applying judgment, and that's what their role is going to become more, because a lot more of the day-to-day processing we expect to become automated. I'm not sure what that looks like for them in the future, or our role in that, but yeah, I think there is going to be kind of a shift in terms of AI. I'm not sure actively. I don't know. We see kind of clients, we speak to clients quite a lot about it, and I think at this point there is a hesitancy to use it from both our team on the ground and our clients, really. I think there's a bit of an unsurety perhaps as to what it can do, because they're not quite used to it. But I don't know what other people are seeing in practice or how it's helping in their roles.
Yeah, I think from a corporate finance perspective, if I go back 20-25 years, there was one of the partners I was working for at the time, there was a big discussion about what do we get paid for, particularly on a transaction, and back then it was expectations changed. So you weren't going to get value, you weren't going to get premium prices for preparing an information memorandum, doing the buyer research. It was all targeted towards end of line delivery. I think what we're seeing within the corporate finance team is it potentially changes what we get paid for. We're just starting to use some of the AI agents and Copilot and things to speed up some of the processes. It's the financial analysis where you can just put in sets of accounts and say, right, identify presenting a report to P, identify 5 or 6 key topics that a funder would be interested in. Now you have to verify it, you have to look at it, you have to look at it for logic, but it just speeds up that process. It as I think Lucy said, it is quite frightening where it could go. Because from a corporate finance perspective, basically the client could do 60% of the job themselves and just say, right, manage the transaction. I found the buyer research. You've now got access to global markets. Whereas before we were looking through databases, we were doing the churn of the database. Now you can add value by looking at the quality of the data that you're getting. So yeah, I think it'll be interesting where we'll be in 4 to 5 years.
Definitely, and just to come in from my own experience and people that speak to, we're similar to yourselves in terms of we're in the trying out mode in terms of seeing what it can do.
Yeah.
Some of the data that we get back is questionable, as you touched on. I mean, we started to write a note which is just internal, and it was making up the wrong Bank of England dates, for example. And it's just like, well, it's a good job that I'm sad enough to know when they actually are. But it's stuff like that you've just got to be really good at sense checking. And I think if we went back 2 or 3 years, I think we probably have another member of the team, if I'm being honest. And it's that kind of entry role where, like you said, where you're doing that groundwork, where you don't have the I don't know, the skills yet to sense check, where as someone who's been doing the job for 20 odd years, like Pete was saying, that you just have the ability to know what's right and what's wrong, and you can do that, and it's a big time saver. So that's the only thing I'd noticed. And I get emails probably about 2 or 3 a week from graduates looking for jobs. And as I said, maybe a few years ago we would be looking for an extra member of the team, but we're just not at the moment because we've got AI helping down doing some heavy lifting for us. I don't know what your experiences of AI have been, Pete.
Well, I worked for a digital bank that's a few years old, and I've got to be honest, it's night and day from one of the big banks. We're actively engaged with AI in the background, not from a customer perspective, but more internally. We've probably spent a small fortune on it, and we'll continue to do so, because if we are going to disrupt the market and play with the big boys, then we have to do something different, and that might keep our costs down, and maybe then we can pass it on to our client base. So AI, personally, at Alica is massive. From the clients I look after, I think it's those with the biggest pockets that are probably playing around with AI a bit more. The smaller SMEs, probably not at this moment in time, because it's too relatively new and unpredictable. I suspect in 5-10 years' time it'll be common practice, or maybe I'm hoping it's more than that, because then I can retire before it takes over my role.
But I was with a client the other day, and we were looking at an acquisition, and they'd gone out and got historical analysis of turnover by customer, and using an AI agent to go through it, and it was it produced the analysis, and it just gave him the ability to look at it and think, what does this mean, rather than spending 3 days trying to work through the numbers on Excel. I think it's changing that. It means you can add
massively,
probably more quality. Yeah.
And like you said, in 2 minutes it can throw out leverage percentages and GPM margins, and you don't have to put it all through spreadsheets, and it can do it all in, like you said, a matter of seconds, can't it? And then you can spend the time actually doing some proper analysis of what actually the data is telling you.
Yeah, absolutely. I think along with the cost pressures that we're seeing supply chain pressures. Alex, can you set the scene for us on how the conflict in the Middle East is disrupting the global supply chains at the moment? What can we expect to see now, 3 months, 6 months, 9 months down the line?
Yeah, well, so these shipping containers, they're just not passing through the Straits of Hormuz, and they're carrying various goods. Probably 20% of the world's oil goes through the Straits of Hormuz on a daily basis. And it takes roughly about, I'd say, 40 days for them to get to their destination. And most of them are going from Iran, they're actually going to China. China are one of the biggest importers of Iranian oil for obvious reasons. There's been sanctions on all other global nations. So where we are now is we're at the point where, those ships have just landed. They've just arrived at their destination. So it's almost like a bit of a slow car crash in a way, because it's just now that you're starting to feel the impact, because in a week's time, in 2 weeks' time, those boats aren't going to be arriving. Not just that, the damage that was done to the Qatari natural gas site, which is part owned by Shell as well. So that was targeted by Iran as part of the kind of retaliation. That's going to take 3 to 5 years to rebuild some of the critical infrastructure. And that's one of the biggest natural gas sites in the world. So, even if this does stop tomorrow, which obviously we all hope it does from a humanitarian perspective, but it doesn't mean that things just go back to normal tomorrow, because it's going to say, as I say, it's 40 days to get these tankers back, traveling goods around the world. And then some of this infrastructure is just going to take a long time to get through. And then, I touched on fertilizer earlier on. We're in planting season at the moment. And if you're not getting the fertilizer out to the farmers to be able to put into the ground, then that means that you're not going to be getting the harvest that you want, which means that you're going to get higher food prices. So that's another situation that we haven't touched on, which is potentially coming down the line as well. So It's very difficult to say, Lucy, because ultimately it's, well, how long is the Straits going to be closed for? The longer it happens, then the more risks and that bubble up and continue to increase from this. But as I said, even if it did open up, it's not going back to normal tomorrow because it takes a long lead time to get these things in play.
Yeah, absolutely. And what is it that clients will see, or what can clients expect to see that gives them kind of almost like a heads up, a warning, a trigger that things are becoming more volatile before the cash becomes impacted? What can they expect to see generally?
I think the best thing to look at is almost the news, because the news will give you a head start on what's going on. And don't get me wrong, there's probably a lot of fake news and there's a lot of headlines out there that don't really help. But that's one guide. But the best way is just to look at commodity prices. Commodity prices give you a good heads up of what's going on. They're quoted on a by second basis in most global markets, and it was the oil price reaction when it went up almost 100% from the beginning of March to the end of March in a very short period of time. So that gives you a good indication of what's going on and the cost pressures that are going to come through.
I think that those costs or those challenges, with regards to supply chain, creates the problem for clients, because do they therefore have to overstock? Because that was an issue I think a couple of years ago when the Ukraine war started, was just getting supplies through, which therefore had an impact on delivery to clients, and therefore clients may be overstocked as a kind of risk mitigation. But then that creates the cash flow pressures with regards, because you're tying a lot of money up into working capital. And it's just, maybe, Pete, you can give us an idea of, making sure that the funding's appropriate for the asset base, because it's historically, there you go, I've got an overdraft from the bank. Yeah, overdrafts are payable on demand. Maybe I think there's now innovation in the way funding is. What funders like Alica can present in terms of, right, we can give you a package of funding that allows you to manage your working capital better.
Well, and I think it's what I said earlier on, is just engage with the funders, because the longer lead time we have, the years it is to support the businesses. Now, I appreciate that's not always possible because not everybody has a contact they can just pick up the phone and speak to. But if I had any one piece of advice for anybody, it's just in the next few days, weeks, months, go and speak to the funders, go and speak to your bank, have a sit down, review your current facilities, because what was right a couple of months ago might not be right now. And it might be that you need an increased facility. It might just be that you need to tweak the existing facilities. It might be a completely new product or suite, whether it is supply finance, whether it is stocking finance, whether it is your box standard overdraft that just needs increasing invoice finance facilities, whatever that may be. Just go and speak and sit down with the funders and the banks and just see what we can do, because we can help and support it.
Yeah.
But the better and more proactive you are as a business, and engaging with the likes of Pearson, doing a forecast so we can see what's coming down the tracks as best we can, the easier it is for us to support.
Yeah, I think that's critical, Pete. We go out to clients all the time, and there's been a new loan that they've kind of gone online for, and I think particularly the COVID era started it. People were online for funding, applied for, and it landed, and it's almost brought this confidence in people that wouldn't necessarily have done so before, that they will just go online and apply for funding rather than have that conversation. And I think as well, it's almost that they wait till it gets to a point and then they'll apply for the funding, and they need that decision immediately. Whereas, absolutely agree that an overdraft or a bank loan, it might not be the best way of doing it, and those conversations with your stakeholders they're absolutely key in making sure that you're setting your business up to win, I suppose.
And I'm alive to the fact it's not as easy as you said, where you can just go and pick up the phone and speak to someone and have a conversation, but there are people you can speak to, and it doesn't have to be necessarily your bank, your funder. Just have a couple of, you have suppliers for everything. You generally have 2 or 3 suppliers. So why not have 2 or 3 suppliers for the finance side of the business, even if it's just a second opinion to say, yes, absolutely, this is what we can do, we can't do, this is what you should be speaking to your banks about. It's worth a cup of coffee, if nothing else.
And when you're looking at funding options then, Pete, how much credence do you put on things like sensitivity analysis? When you're looking at that with regards to sensitizing the forecasts, identifying what appropriate level of headroom is appropriate.
You know where we work as banks, we like to sensitize everything. Sensitize top line, sensitize margin, sensitize cost up. I mean, the one we do right now, obviously, is energy costs. So we'll take your existing performance and sensitize your energy cost 10, 20, 30% and see what happens to bottom line if nothing else changes.
Yeah.
But it should, and hopefully, like Alex alluded to, be a short to medium term problem, depending on Mr. Trump and when he's going to finish this. So, it might just be a facility that for 3, 6, 9, 12 months, it might be a longer term.
Yeah.
Alex, what are your thoughts on that in terms of what does a fundable business look like and how cost pressures and supply chain and cash discipline affect that picture?
It's so difficult that because it really impacts in individual industries differently. I mean, for us, for example, we're financial services, so we're not really feeling the impact at all at the moment. I mean, we get more impacted by markets moving around than anything else. We're not seeing the cost pressures coming through because we don't have any imports coming through. So it is very specific to the business that you're in. As you mentioned, manufacturing businesses are going to be more impacted by this. I think the other point to maybe mention is when the OECD came out with some data last week, I think it was, maybe the week before, and basically said that since the conflict started, the country that's going to be most impacted by these developments is the UK, which is not really something you wanted to read, is it really? But it's because we're so reliant on importing, and our energy infrastructure is the same. So I think as us as a country, we need to be really mindful of that and look to change some of our behaviour in the way that we do things, to make us more resilient for things that come down the line in the future. Because as we've seen and we touched on, these things seem to be happening on a more and more regular basis. So we need to be more resilient as a country from our energy perspective to minimise the impacts when they do happen.
Yeah, absolutely. And I think that resilience thing for businesses, it often does come down to visibility and planning. Businesses need that better, that forward visibility over their orders, their stock, that where it's coming from, their supplier lead times. And I think often people are so busy working in it, they're subconsciously, they know that it's all happening, but there's not that kind of analysis of their supply chain or their processes that really kind of ironclad it and make it resilient to when things like this happen. And I think, I don't know, we're going to come on to this later, but that is one thing that I would absolutely kind of be encouraging clients to do, is to look at their supply chains and how they are, they're protecting them, I suppose. And I think as well, just touching on something Steve said earlier around, it's the picture that we present then to funders, i.e. Pete, we give clients to you, and it needs to make sense essentially, but it's that ease of compiling that financial information when businesses are looking for funding from an accountant's perspective. Anyway, we kind of, any of the variable costs that we see, the better businesses that we have, they're on top of their figures and are very, very reactive to it. We don't see kind of a great deal of high level, accurate cash flow forecasting, but I think it is about knowing your figures and knowing that business and having that information readily available to spot these trends and then change tack and move forward, and not let them kind of, I don't know, be 3 months down the line and you're getting your information and you're noticing that you've got a problem that you could have picked up and sorted so that there was less impact, say, on financial statements.
I think picking up on something that Lucy's side of the business would do, that, you talk to clients and, we deal with all types of businesses. Sometimes you're selling a business. Have you got your 12 months management accounts? I don't do them. And we think, right, well, generally small entrepreneurial owner managed businesses, they know their business, they know what's happening, so they've never needed to do management accounts. I think what you sometimes, what we sometimes see is I think Lucy just said there, whether people understand the financial statements. You see can we have your management accounts, and the client just produces, prints it off from the system, maybe put some journals through, and you've got a profit and loss account that might be 50 lines long. They're not focusing on what are the key drivers in my business, the kind of key performance indicators. When we've done some transactions, quite large funding transactions, and we've picked up the management reporting, and what we do as part of the information pack is just watching Alex plunge into darkness. We put an information pack together each month that identifies the key performance indicators. And is that relevant for individual? Do you look at that, Pete, when when you're looking at financial information? Do you look at businesses that try to identify? Do they understand their KPIs? What's driving the business?
Absolutely, and we go through it line by line. I mean, we're boring bankers, I suppose, at the end of the day, but it's important to us, and we will go line by line, and we will go trend by trend. Especially, it doesn't really matter whether you're asking for 50 grand or you're asking for 10 million. We review every cost line to see where the pressures are and what the increases are, and whether that's more pertinent is whether that is what everybody else in the industry is seeing as well, or whether that's just business specific on that particular business and why is that happening. And we will challenge.
But I suppose these, you talk about control the controllables.
Yeah.
What every business owner has the ability to do is understand their numbers. They might not be interested in the management account and producing the monthly management accounts, but do they understand what's driving it? Do they understand what costs they can take out? What's a discretionary cost? What the labour rates? What's our turnover or labour turnover, or turnover by employee? What are the costs? The overtime costs. It's kind of, I think that's key for businesses in moving through these uncertain times. Is yes, you can have your management accounts produced, but do you really understand what's driving it forward?
And even breaking it down into,
sorry, Pete.
I get a lot of growing businesses that are just concentrating on top line sales.
Yeah.
Profits falling away. So you're taking on really good contracts, which at top line look really good. But when you break it down and understand what the costs are on that, you're making little to nothing. So you end up running, I hate this phrase, but like a busy fool. So your top line's going really high, but your margins are being eroded.
And I think, from my experience, when we go back to that COVID period, I think that's what the really successful businesses were able to do, is COVID made them rationalise, and it made them look at the business and think, right, are we being busy fools? Yep. Are we driving just for turnover growth, where actually we can be 60% of our size and actually be just as profitable? So I think that COVID, because COVID was a massive shock to everybody, wasn't it? You were walking down the street and people were jumping into the road to avoid you. Well, that was maybe just me, but you've got that. I think it gave people had to look at the businesses at that point. And I think maybe going back to your point, Alex, at the beginning, where people just got a bit blasé about, these shocks happening every, we've got a new prime minister every 6 months. People are just ignoring it and being a bit stoic and getting on with it. Whereas maybe this is a chance to actually, maybe step back every 6 months and think, are we being busy fools? Are we just chasing turnover? Yeah.
COVID was a unique period, weren't it? Because businesses had the opportunity. I mean, most business owners are running 100 mile an hour just to keep up, aren't they? But COVID gave people the opportunity, not through no fault of their own, because a lot of businesses had to close, to step back and have a look at each cost line by line. And it must be challenging. It must be very difficult for business owners who are just trying to run at 100 mile an hour to keep up. to take a step back, but sometimes it's what you have to do.
Yeah.
I agree. I think from our experience within that COVID period, I think it did reshape the thinking
Yeah.
of a lot of business owners. It was a long, hard period, and I think they took that time to step back and think, is this worth it? Where can I generate the most value? Not for the least amount of effort, but what is just taking far too much of my time up at this point that I don't need the stress of it. I think that was a real point within businesses and COVID. I'm just conscious of time. So I think finally, guys, if you were sitting today in the audience running an SME, what is the single action that you'd prioritise in the next 90 days to protect cash and manage your risk?
Do you want to go first, Pete?
You won't be surprised. Strong external stakeholder engagement. Go and have a meeting with Pierce's, go and have a meeting with a funder of banks, sit down and review the current facilities that you've got. Are they fit for purpose? Hey, is your money working as hard as it possibly can? Is your money just sat in a high street bank earning zero? Because high street banks will rely on apathy and the fact that people don't like to move. Just have a conversation with your external stakeholders where possible. That would be my advice.
I think also maybe picking up on the wider stakeholder thing is, debtor management. Somebody's, in effect, you've made a sale. You've not really finished it until you've collected that money in, and it's actually being proactive and engaging with your clients with regards to debt collection. Because most people, they'll kind of play a game and say, well, I'll just hold on to that until somebody chases me. As soon as you chase them, they'll pay it. Because most people don't like being nasty. So I think it's just being proactive in that, utilising your working capital better, and maybe on the other side, stretching your creditors a little bit. I was talking to a client a few weeks ago, and his father does all the bookkeeping, and he kind of wondered. And I said, what are your credit days? None. What do you mean none? I said, I pay every creditor when I get the invoice. What are you doing that for? You've like £600,000, in terms of 2 months invoicing. And I think it's just not so much playing the game, but it's just actively working. We're managing your working capital, because as your funding is your funding is addition to that. If you can get that working capital cycle working properly, the funding that Pete can add on to the top of it is just extra, and it gives you more comfort. But I think it's controlling what you can, and that's up to your debtors and your creditors.
Absolutely. And some of the creditor agreements and debtor agreements in place might be historic. They might just need reviewing.
Yeah.
As a bigger business, you might be able to negotiate better creditor terms with your suppliers, which may then help cash flow.
I think I'm with you, Pete. I think it's that stakeholder support. Yeah. I think seasoned business owners, or in my experience, business owners, they are in tune with their business. It can be more kind of subconsciously than consciously, but they know the pain points and they know the thoughts that are kind of keeping them up at night, or they're hearing from their team on the floor, such and such haven't paid, sales aren't on target, we need to delay that spend until we've paid the VAT bill or the CT bill. And I think these are early warning signs for business owners about what is going on in their world. And I think sometimes they remedy themselves, the person pays, sometimes they don't remedy themselves and they lose money, or they kind of lose a contract. But I think business owners are so busy working in the business rather than on it, that it's kind of, there's an issue, it remedies, or there's an issue and it sorts itself out, and then it's almost onto the next one. And I think stopping and assessing their internal controls and how they prevent it. And I think, I'd top 5 pain points, and then, as you're saying, I'd get those people in the room that can really challenge you and support you on it, and just say, are we set up for this, and how can we do it better? I know as an accountant, if somebody asked me to come into one of those meetings, I'd be delighted. It's exactly the kind of thing we want to be doing and helping our clients with. I think we see so much. We see I don't know, just from a, I don't know, credit insurance and debtors, for example, we see people insure their debts. We can tell you roughly what it'll cost on a turnover business, and what information that can give you in terms of what sectors are kind of seen as high risk by people. So I think it is having those meetings with your stakeholders and using them. They're there to be used essentially. Alex, what about you? What would your top priority be?
I think you've nailed on the head there. I'm just trying to think if there's anything else. I mean, individuals know their business better. It's always a good time to sit down and evaluate, do some stress testing, whether that's with yourself or an external expert to help you do that. Think about what, plan for the worst situation. What happens if this carries on for, the Ukraine-Russia war still going on now, and over 4 years in. So, think about the different scenarios, but I'd also not try to worry too much. As I said, we've been through this in the past. We've gone through difficult times, and businesses, individuals have got that great ability to be able to adapt to different environments. So have faith in yourselves and keep going.
Thank you. I think that brings us to the end of the points that we had to discuss. Thank you to everyone for joining us today. Hopefully you found it useful and have some takeaways. We are going to stick around for another 5-10 minutes if anybody wants to ask anything. If you've any follow-ups or you want to speak to anybody after, just let us know and we will coordinate. We'll coordinate that for you. Thank you.